People are fearful of making mistakes. And the only way to achieve anything in life is to make a heck of a lot of mistakes. The difference between success and failure is how you respond to those mistakes. Now, if you make a mistake and you fall in a heap and you go, I lost some money on a trade, I'm never investing again, it's a wasted opportunity, a missed opportunity for you. If you've made a mistake and lost money, the best investment you can do is to learn from that mistake. Then it wasn't a cash loss, it was actually an investment in your education. And I appreciate that sounds like a little bit of a cute way of softening the pain. No one likes to lose money. But if you can explore what went wrong, fix it, and then approach the market in a different way, you can make that mistake back and some. So all mistakes are positive if you choose to frame them out that way, yet psychologically, and I don't know what it is, whether it's the way we're programmed from school or otherwise, everyone's so fearful of mistakes. You want to make a lot of mistakes in your life, a lot of bad decisions, because that's how you make some really great ones too. You don't learn anything if you do nothing. Hey guys, welcome to this week's Money and Investing Show. This week we are looking at 5 traps to avoid when it comes to investing in 2025. We're going to talk about process, we're going to talk about psychology, but most of all we're going to lay out a game plan that will help you stay on the straight and narrow when it comes time to optimize your investments. As always, don't just take notes, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Looking good, Mr. B. Nice in cash today. It is hot outside. I certainly don't blame you.
Yeah, not through choice. I was at a barbecue last night, and then my wife and I have been in hospital. She's nearly went into labour last night at 26 weeks. So this is after sleeping on the couch in the maternity ward last night. But there we have it.
Well, hopefully she's okay. You look good in any case.
No correlation between clothes and investment advice. This is going to be a very, very solid session. And you know something? People often watch this sort of stuff and they go, oh, you're not wearing a suit and tie, therefore what would you know? I can wear this because I can.
That's right. Absolutely. Well, today's going to be a fun episode. We're going to talk about 5 common mistakes to avoid in 2025 in the stock market. Bit of context, though, before we get into these mistakes, and we can trade a few blows here as we go through the list. Mistakes are made all of the time in whatever you're doing, particularly in the stock market. And the beauty of it being a market, there's always a buyer and seller for every reason, right? Well, in your opinion, why do mistakes happen so regularly?
Well, let's take a step back if we can on this.
All right.
Like, people are fearful of making mistakes. And the only way to achieve anything in life is to make a heck of a lot of mistakes. The difference between success and failure is how you respond to those mistakes. Now, if you make a mistake and you fall in a heap and you go, I lost some money on a trade, I'm never investing again, it's a wasted opportunity, a missed opportunity for you. If you've made a mistake and lost money, the best investment you can do is to learn from that mistake. Then it wasn't a cash loss, it was actually an investment in your education. And I appreciate that sounds like a little bit of a cute way of softening the pain. No one likes to lose money. But if you can explore what went wrong, fix it, and then approach the market in a different way, you can make that mistake back and some. So all mistakes are positive if you choose to frame them out that way, yet psychologically, and I don't know what it is, whether it's the way we're programmed from school or otherwise, everyone's so fearful of mistakes. You want to make a lot of mistakes in your life, a lot of bad decisions, because that's how you make some really great ones too. You don't learn anything if you do nothing.
That's right. And hopefully from our failings and our mistakes that we can share that knowledge with our listeners. Look, I think personally, speaking on the trading desk each day, the thing that I come across a lot is just the emotional nature of people when it comes to their money. And I know we talk about this extensively at boot camp and within our education.
Well, explore the relationship, right? And most people have this umbilical cord, a bit topical for me right now, but this umbilical cord relationship with money where there's such a massive emotional connection. So why is that? Well, if you think about it, you got to go to work, you got to earn your dough, you might have to sacrifice time away from your family, you might have to put up with a co-worker or a boss or an organization that you don't want to be part of. You then, having earned your cash, have to pay your tax. And then, given the cost of living environment we're in right now, if you manage to save some money after you've done all that, paid your bills, paid your mortgage, put food on the table, etc., that money that you've got left saved, as an investor, we're then going to say, okay, well done for getting to that point, which is the start line. Now what we're going to ask you to do is deliberately expose that to risk where you could lose some of it. And so you can understand why there's a red stop sign for so many people, and that emotional attachment to that, because I've had to work so hard to even get to the start line without getting any outcome. So there is so much emotional baggage with money. And the best advice I'd ever give anyone from our clients or anybody that I speak to when it comes to getting them up and running successfully as an investor, not up and running, but up and running successfully as an investor, is to try and break that emotional connection to money and think about it instead of being dollars as just simply units. And I had to do that very, very early on in my career. When you're working with the kind of large numbers that institutions do, particularly in the City of London, it can be really overwhelming. Yet $100 trade is the same as $1,000 trade, is the same as $1 million trade, is the same as $100 million trade, is the same as $1 billion trade. The process is the same, it's just the scale of it. And if you let that scale get to you, your decision making goes out the window. They're just units.
Totally. You become almost desensitized to it the more that you actually practice that kind of philosophy, because I know you taught me that very early on in my career. The more objective you can remain in your decision making, which, as we know, results in better profits down the line.
100%. And it's a step that so many people miss out. That they think, okay, trading is looking at charts or following news or following recommendations or learning a strategy. Success in investing, and I know we're spending a lot of time on mindset, that to me, that trading psychology, that mindset mastery is the missing link for nearly everybody that doesn't take the time to learn how to invest properly. It's not about technique, it's that ability to build your confidence in yourself to discharge the process of trading. And and if you don't get that step ticked off, you bring emotion to every other decision that follows that. And if you bring emotion to decisions, they're terrible usually. That's
right. Well, most of the mistakes I'm sure we'll cover today as we go through will be primarily emotionally driven. So let's kick off. And if you don't mind, I'll start off the batting here. I'll open the batting here.
What have you got lined up, man?
Well, I think number one, one mistake I see all the time is panic selling. And as soon as the market has even a wiggle or a waggle down, pullback, correction, whatever you want to say, people often feel the need to unload their holdings, when really, if you've bought into a quality business that's got great long-term future prospects with great earnings growth and all the rest of it because you've done your research, there should be a reason to be buying more, not selling it.
It's almost the opposite, isn't it? It's panic selling that get me out at any price. And I've seen it firsthand in London during some really big corrections, and you literally see the whites of people's eyes. You sense it over the phone as a broker when you're talking to clients, that tonality from just get me out, I don't care about the price, just get me out. And it's a totally irrational thing. Markets move up, markets move down, and you're quite right. If you've done the work, and this comes out, the only place in life success comes before work is in the dictionary. If you've done the work, you're fine. If you haven't done the work and you're winging it or hoping, we'll get onto those, I'm sure, you're in real trouble. So if you've looked at a stock, and I don't mean falling in love with a stock and being I guess, blinded and not seeing the weaknesses it might have, but if you've got something that is on the grind, got earnings growth, is profitable, is in a sector that's growing, that's got positive momentum as far, because that's all about the business, and then from a trading or markets perspective, has got buyer support behind it, is in an uptrend, has got buying pressure typically sitting behind it. In other words, it's not today, but overall, you look at the last week, month, year, 2 years, 5 years, has been in an uptrend and has continued to have growth prospects. Of course, there's going to be a pullback, and it's kind of like running up a hill, and you're a fit man. I know you're training for your ultra marathon at the moment.
Yes.
At some point, you've got to put your hands on your knees and suck a few big breaths in. If you run up a hill, you can't run up it perpetually. You've got to stop, catch your breath, and go again. And stocks are exactly the same. Well, buyers reassess whether it's still a buy, where sellers go, that's me taking my profit. And that's a conscious decision, deciding to take your profit. But when you hit the sell button because you've had a couple of red days and you think the end of the world is there, what it highlights more than anything is either A, you haven't done the work, B, you haven't got control of yourself mentally or emotionally around money, or C, you don't have a strong goal and understanding of what investing is. Investing is a long-term process, and sure, there are short-term profits within that. We understand that. But you have to accept that markets don't go bottom left, top right. But if you've done the work, pick good quality stocks, you've done the work in terms of backing yourself mentally to say, okay, I'm going to ride out some volatility through this. Hitting the panic button and getting out is just about the dumbest thing you can do.
It's funny you said. They had a client maybe a few years ago, and I won't mention his name, obviously. I actually had a meeting. So there was a pullback in the market. There was a couple of red days, as you say, and things are pretty uncertain in the market. In that week, I went to a meeting. I was there for an hour. I came back and I had 17 missed phone calls from this particular client. When I called him back, he said, same thing, sell everything, get me out now.
Yep.
I guess more than anything, it highlights how emotive people can become to call their broker 17 times in an hour just to sell out of the stocks, which, in a month's time are actually back at where they were trading at.
Well, that's the second half of the problem. And you go, look, you can always buy back in. That's a lovely. You can always buy back in. That just rolls off the tongue beautifully. And as having been a broker myself, you can always buy back in. Yeah, it's so easy to say to somebody. But psychologically, once you've gotten out of something, trying to convince yourself to get back in, you need to see so much proof that it's back on track. So let's say you've been in a stock, you bought it for $20. It hit 30 and it's pulled back to 28, and you've gone, I'm out at 28 because I'm not giving away my gains here. You get out at 28 and you think, you can always buy back in. I bet you don't get back in until it's at least $31, $32, $33, $34 because it's probably going to pull back again, and you delay your decision making and you miss out on that opportunity. And that trying to time the market of being able to get out and back in is such a massively ninja level, high level skill where you need multiple layers of analysis, things like a signal screener that of course your team have put together, and various things in that area can assist. But you've got to be ninja like to better hit that button. Whereas if you'd have just left it alone and let it do its thing, you'd still be in it at $34 and effectively have significantly more profit in your account.
That's right.
And that's very different from a stock crumbling, fading, failing, and enjoying a more significant downtrend. But that's where your view on the stock has changed, not the price action over a couple of days. And there's a huge difference between the two. Stocks, their business models change. They lose touch with the market. Take GE as an example. Through the 80s and 90s, that was the blue chip stock of choice. And then it went through a decade and a half of you wouldn't touch it with a barge pole. The view on the stock changed considerably. That's not 2 days of pullback. That's getting out because, as I said previously, it's not just about how the business functions. It's how the market sees that business too. And if there's not buying pressure, it ain't going up. And that's what you've got to be minded of.
Well, speaking of buying pressure, if we can transition here to number 2, and I think this is a perfect segue, so thank you for that. Mistake number 2 to avoid this year is to stop buying based on FOMO. I mean, we're in an environment where 2 years we've seen particularly the NASDAQ go out of control to the upside, the tech sector gone ballistic, and the Magnificent Seven done even better than that. Very, very easy now to say after 2 years, now I'm going to hit the go button and start getting in.
Yeah, look, you'd have a fairly sluggish decision-making process if it's taken you 2 years of 50+% returns out of the NASDAQ to finally go, okay, I might buy some of this. Yeah. But as a human being, sometimes that's what we need, especially if we've taken some bark off and had a bad experience in the past, because, again, that threshold for making a decision is much higher. It's never going to keep going. It did keep going. Okay, but it'll have a pullback, which it didn't then have. You go, okay, this has to come to an end. It's the end of the year, and then it didn't. And then there's the Santa rally, and then you got, okay, there's an election cycle, so we'll wait till that's out of the way. And then there's the next thing, and then the next thing, and before you know it, there's 3, 4, 5 years you've missed out. And it is very, very hard when things have run up and you start to chase them. So One of the I'll talk about property in a minute on that, because I literally had to pull myself on this with a property the other day. I'm looking at some more investment properties at the moment, and this one was in Brisbane in New Farm, and I spoke to the agent, and they gave me this number, and it's like, you've got to be kidding, and it's like, and I said, but how have you arrived at that number? It's like a 2% yield.
Oh, based on what it was renting for versus what they wanted? Okay.
2% yield. And the particular building it's in is, the owner's corp fees are reasonably meaty. Great building. And it's like, how'd you come up with those numbers? And they said, well, it's more of an owner occupier than an investor property, but the frame is the same. You're paying way too much for something. You make your money when you buy, not when you sell. And I've been chasing that particular, it's quite a specific property. I've been chasing it for a while, and I just pulled myself up on it and go, no. Don't
let the FOMO get the better of you, right?
So it can happen. And I mean, my lane is well, I've done plenty of real estate too, but my lane is stock market. But it's the same thing. We get emotionally charged around it. So how do you avoid that? One of the tools, a bit more advanced, I suppose, and I mean, we teach this, as you well know, is that notion of selling puts on something. So if you've got something that's in an uptrend and you don't want to chase it to its next price level, or it's just to sell a put. And if it has a pullback and you get set, number one, you've been paid for selling the put. And number two, you're in from probably a lower level, which you can probably live with psychologically too. So it's a win-win. the key thing with that is, number one, you've got to really want to have the stock if you're going to sell puts, and secondly, you've got to have the cash to make sure that you can settle on it.
Just like buying it, but you being paid for it, right?
Yeah, you're just delaying your buying decision. And look, if you don't get set and it keeps going up, you're still picking up a little bit of income along the way, which might be 2%, 3% for the month, depending on what it is that you're trading. And that's a way of, how can I put it, taking the emotion out of that decision to buy. And I can give you an example of taking the emotion out of a decision to sell in a moment. But yeah, that's one way of dealing with FOMO. What else have you got?
Well, I think market timing plays, look, assuming you're not taking an investment approach, assuming you're taking a more active approach, using market timing. So one strategy that we often will run for our sort of trading division is RSI 4. And that is relatively short term, but we're looking for the strongest stocks in a strong uptrend.
Yep.
When they've pulled back and they've gone oversold, which means, they've been pummeled over a few days, we then pick them up with the intention of seeing them continue to move higher.
Gotcha.
Now that strategy is really good because it takes advantage of momentum and then factors in market timing, which does require an additional skill set. It's stuff that we teach through our advanced options program mainly.
That sounds quite tricky. Let's make that dead simple. So you're supporting Australia. Well, Andrew Forrest these days, of course, beautiful pair of RMs.
Thank you.
Slightly
Pink socks as well.
Oh yeah,
sock game.
No sock game barbecue, as I say before. I was off to the hospital, so I didn't get a chance to get dressed.
We'll let you off today
for the studio today. So pair of Iron Williams boots, let's say they're $800. You're buying a quality product, let's push it because it's Australian and it's all about making Australia great again.
Yep.
If you had the chance to buy them for $600 and they're normally $800, it's a no-brainer.
Definitely.
Because they're in the sale.
Yep.
When stocks have a pullback, the psychology I think that can help people, if it's a quality product, if it's a quality stock that you genuinely want to have,
that's right,
then buying it in the sale makes an awful lot of sense. So that pullback is the time to buy. Yet psychologically, nobody particularly, unless they're savvy and they've been trained in the way that we train our clients, wants to buy on a pullback because, oh no, it's going down. It's like, yeah, and it might go down a little bit more, but what you're doing is getting it less than what it was 3 days ago when you were happy to buy it 3 days ago. So don't let the emotion, the noise of what's going on in the market cloud your decision making. If it's a quality product and you can get it less than what you thought you were going to pay for it, buy it now.
Definitely. It's on sale, right? It's a great deal.
Never, sales are great. Never pay full price for anything.
Never.
So just talking about that ability to avoid FOMO by selling puts. The reason I like that notion is that it removes the emotion, while I like that process, it removes the emotion from the decision. In that if you're assigned on your option, it wasn't you that decided to buy the stock, it was just the mechanics of what goes on in the market. And again, if this isn't making sense to our listeners or viewers right now, this is the kind of stuff we teach a little bit further along the line, but it's a very, very useful way of managing yourself through markets. You can do the same thing for an exit. So selling can be a very, very emotional decision for somebody too. And taking that emotional pressure off of someone, I'll give you a really extreme example of this. So I had a client quite a number of years ago whose husband had left her a portfolio of shares. And he'd passed quite some time, probably 2 or 3 years earlier. And the particular lady had moved house and done a number of other things, changed cars, travelled, done some stuff, but she had this portfolio of shares that was something he was quite adamant about leaving. And she wanted to close it out, but she felt it was very, very difficult to sell those shares because it was a really strong emotional connection to the husband. And so what we did, we began to sell calls over the stock. In other words, a covered call or cash flow on demand strategy, that which we use for income for our strategies. And the way we catched it with the client is, look, the bonus is you're getting paid income every month. And should the share price move up and you sell the shares, it's not you selling the shares, so you don't need to feel guilty. It's the process within the market. So we quarantine the emotional part of that decision making. And the particular conversation with the client was, and it's a really personal client, quite close to me, was that with the proceeds, the income from selling the options, go and buy a really nice piece of jewelry. And she liked it. It was a beautiful ring that she bought, which she still has to this day. And that now is a long-term, tenable, tangible connection to the husband that had passed away.
Gotcha. That
he'd been able to buy as a gift to say, here. And that enabled her to then unload the shares without the emotional guilt of selling something that she'd been gifted. There's so many layers of complexity in there. And it's only by virtue of the fact I've got a very good, tight relationship with that person. I was able to coach them and walk them through that particular process to get their outcome. But I think what it highlights more than anything else is that nemesis of emotion when it comes to decision making. You have to, and I think the term I just used was quarantine it somehow.
Interesting.
And options can be a very good way of doing that.
So moving forwards then to number 3 here, one that springs to mind on the topic of emotion is letting your losses run and cutting your profits early. Double-edged sword, that one.
Yeah, I think if you've been on a bit of a tricky run, any profit's a good profit because you just need to get that confidence back, get a couple of wins. You can see it, if you watch the cricket, for example, one of my father-in-law was a teacher, and one of the kids he taught is playing for the Brisbane Heat.
Oh, wow.
And has been, and he's had a really bad couple of years where he hasn't had a 50 for a couple of years, Max Bryant. And yet this year is just smashing it out of the park because he's got his mojo back.
Yep.
But watching him when he was really struggling, any runs are good runs when you're getting none. And so you start to cut your decision-making short. Well, in the same way with trading, if you've had a bit of a bad run in the market, as soon as you get a little bit of a profit, you think, some green ink, that's a win. I've got to have a couple of wins just to put some fuel in my tank. These are all emotional things we're talking about. Yet this should be, in theory, and certainly the way we play the game, there's zero emotion. So you don't need to do that. You just need to be able to follow your process. So when you start to cut your profits early, what you're effectively doing is really having a detrimental impact on your equity curve. And we'll get on to longer running losses in just a moment. So if you have a trade, you cut it out at 4% and it could have made you 30, that 30% gain that you could have had would have assuaged the losses that you've previously had, would have got your account back in the black. And instead, you're compounding bad habits of letting emotion make those decisions. So you can't do that. You have to let your profits run. Ways of doing it: have a sliding stop loss trailing up behind it, for example, is a very simple way of letting your wins run. If you're really in deep profit with something, buy a put option. Use some of the profit to ensure the profits and gains that you've made to be able to let the trade run again. Maybe taking some money off the table and doing a cash extraction, which I know you guys have done, billions of dollars worth of those over the time.
We have.
Where you buy a longer dated call. You close maybe half the position in the stock or even all the position in the stock, and then buy a long dated call option to perform in line with the stock if it keeps going up, but you've got the cash and the profit out. These are all ways you can let that money run that are objective, as opposed to that knee-jerk reaction of, got to get out. I've made a profit. I just need that fuel. I need that bite of a chocolate bar to make me feel good.
Yeah.
So that's on that side of the ledger. And letting your losses run, again, is a reflection of human nature. Nobody likes to be wrong. And trading is a business that you're going to be wrong a lot. And if I go back to how we prefaced this right at the start, mistakes are very healthy as long as you use them in a productive way. If you make a mistake on a trade and it doesn't work out and you cut your losses nice and early, clean and tidy, that's a learning experience. If you took the same trade and chose not to exit, she'll be right, we'll give it a bit of time, give it another day, see how it goes. And if the stock really has changed and it starts to move into a more catastrophic downtrend, and you're holding this thing all the way down where your capital is tied up, every time you turn on your trading screen, the first thing you will look at, I can guarantee, is the P&L on that nasty trade that you've got in the cupboard. It's like having, you're a semi-bachelor. Can you use that term?
No, not anymore. I'm off the market.
Off the market. There's going to be
completely.
Do you know something? There's going to be. You can hear the sad sigh coming from our audience when you say that.
I think our viewership just halved, unfortunately. Sorry to say.
If you imagine at the back of your fridge, you've got some rotten fruit. you know it's in there. You can smell it, but you don't want to have the fortitude to go. I'll go and put that in the bin. Just leave it in there for a period of time. Well, a portfolio of shares can be like that if you've got something that's not good. And to give you a first-hand example, very dear friend and client of ours down in Melbourne, very successful investor, very, very smart guy, had a position that he was holding because he didn't want to wash it out. He could afford to ride it out. But every time he looked at it, it just gave him, in the end, he just purged it. And he said it's the best day of his life. It's like selling your boat.
Just get rid of it.
Best day of your life is when you buy your boat. Next best day of your life is when you sell it.
Yeah.
He said it's just like that. You just gone and felt much better about life there. And when you hold on to those losses, it takes a toll. And not just financially, but also emotionally. And look, I've no doubt we have a massive audience that consume this podcast. And there'll be people listening to this potentially with their arms folded going, oh, no, they always come back. They don't always come back. Babcock & Brown, Elco, Manheiser Mines, Pasminco, just to name a few, they don't always come back. If you look at the Australian market, it took 12 years to recover from the GFC. That's an awful long time to watch your money underwater. And then eventually it gets back to break even. You go, see, I told you it would come back, but what's a property value done in that 12-year period? What can you buy with that money? You're better off getting out. First cut's the cheapest. Have a listen to the podcast interview I did with Nick Leeson probably 3 or 4 years ago. First cut's the cheapest. Take it, get it done, and avoid those holding on to losses because they're crippling.
Sage advice for sure.
Yeah, financially and emotionally, and it's the emotional one that you don't recover from. Financially, you always make more money. Emotionally, once every battle leaves an element of your soul behind. And if you've had a decent loss in markets and you've compounded it by not taking action or choosing to take inaction is probably the term, that's on you, and that does take its pound of flesh from your soul. You've got to live with yourself after that, and that's not fun.
Definitely not.
He says, speaking from experience.
Yeah, me too, right? Number 4 then, AB, as we move forwards, and let's get away from the emotion and get more into potentially process discipline, and that's not having a plan, hoping. So, this probably leads on from what our conversation was just then, but I think a lot of beginners in particular just buy and hope, and that's the strategy.
Yeah. Look, the goal of getting people investing, our organizational directive, I suppose, is to help remove the friction for people, because you're better starting than not starting. It's like, you go for a run for 2 minutes, you're 2 minutes closer to a marathon than someone sitting on the couch, right? Simple as that. So it's good to get started. But once you've made that initial decision to build some momentum, the next thing is to try and make sure you start in the most effective and efficient way you can, and you have to have a process for that. We've been in a situation where markets have been pretty bullish over the last few years, and buying virtually anything, whether it be property, crypto, or stock market assets, should have done quite well. And you can think, well, that was pretty easy, but you can't build a successful financial future on luck, because that runs out. And most definitely, you can't build it on hoping that the circumstance is going to be. There's got to be a process that sits behind it. So, I'm of the view that learn it once, learn it right, live off it forever. And that's very much our philosophy with our education business, to build that process out, because when the process is right, the results always follow. And looking at it through a different lens, if you might go in the kitchen and you might freestyle something and it's fantastic. And you go, gee, that was great. How did I do that again? Oh, I can't remember. So you can never replicate that success. If you've got a process, which when it comes to cooking is called a recipe, and you follow the same recipe over again, over time you can customize it to really suit your taste buds, but the foundation is there. Trading and investing is the same. Learn how to read a chart. Learn to understand how macroeconomics can affect certain sectors. Learn a bit about yourself. How do you feel when you've got real money on a trade? It's one of the reasons we don't encourage paper trading, because it's fake. It doesn't give you anything other than this false sense of confidence. Removing hope couldn't stress enough that you have to replace hope with a process.
Totally. You're going to have a plan, right? I think before you get into any trade, know what your exit is before you even get in. And that way, if you need to close it out, you need to take profit, you've already written it down and accounted for everything. Yep.
Prepare for the best, expect for the worst. If it drops somewhere in between, you're on point. And you're quite right. If you do the steps you've mentioned, where am I going to get in? Where am I going to take profit? Or where am I going to cut my loss if it goes wrong? Just those 3 very, very simple marker points. If you can attend to those, write them down, commit to them before you get in the trade, you are likely to be in a far better position than someone that's going to get into the trade and try and wing it and go, okay, if this happens, I'll have a think about that. Because as soon as you own something, you become vulnerable to, sorry to go back into mindset and psychology again, but something called the endowment effect. When you own something, you feel differently about it. It's like, that's my mug that I drink out of, and if someone else in the office is drinking out of it, I'll get a bit upset because that's my special mug. They're all the same, but that's the one you like for whatever reason. It's the one that's not chipped, or maybe it's clean when it comes out of the dishwasher, whatever it might be. It means something more to you than just being a mug. Stocks are the same. Once you own them, you'll overlook all of their foibles and failings because it's your stock, it's special. So you're quite right. You've got to get that in, out, or cut your position worked out before you even commit dollars to it. That way you're looking at it objectively.
Absolutely. And last but not least, AB, our mistake to avoid this year in 2025. I mean, it's been a busy market the last couple of years. It's not to overtrade. We see this all the time. Headline to headline, in, out. That way you've just got everything going on, but you've really got nothing happening.
Yeah, you kind of bounce around and eventually it'll leave you very fatigued. We're in a broking business. We're in the transactional space, of course. When clients are active, that's good for our bottom line. But we're all about win-win with our clients' partnership. And so if we can have clients making great money by holding positions and really milking them for what they are, that is a very good outcome for us too. Interestingly, I was chatting with one of our, he's actually a Trade of the Year last year, and I suspect he's going to have a reasonable tilt, and I know he's going to be listening to our podcast, so thanks for the tips on a man, Stuart, much appreciated. About 1,000 trades last year, which is really active. It's also a very sizable portfolio.
Yeah.
But it's not over trading because there's multiple slices of the same stock. They have a process where they've got different levels into the same stocks. It's not like, let's find a million different things we can trade.
It's the one thing.
Let's find a handful of trades that we can finesse. It's why this guy's so successful. His discipline is absolutely exemplary.
That's
and
crazy.
I might add that the execution, which is conducted by his wife Jill, is second to none. She's great at actually making sure the go button gets hit. So
great team.
That's not over trading, but it is a lot of trades. Over trading is where you constantly, it's almost like scrolling on Facebook or Instagram, where you're just getting that dopamine hit by looking for the next thing and the next thing rather than standing your ground on quality positions. So getting in and adding to a position isn't over trading. Looking for the next thing without digging in and doing your research. And look, let's face it, you can be a very busy fool if you're doing that, because that's a lot of companies to research, a lot of different trends to analyze. If you've got 8-10 things that you follow religiously and then just add or reduce positions accordingly, that to me makes an awful lot of sense, because you're going to be far more accurate with what you're doing and less burnt out as a trader.
Totally. I think it's better to have specialist knowledge of a small amount of stocks than it is a general knowledge of a large amount of stocks.
And then as your knowledge increases, you can adjust the strategies too. So it's not just about getting in and out. You might say, look, I'll approach that with, I'm going to sell a put, or I'll buy a long dated call, or do a spread or a straddle around that, because you've got a stronger view on the underlying instrument. You can have more confidence then of leaning into maybe a little bit more of an advanced strategy, which I know you guys spend an awful lot of time with their clients on in the trading desk.
Totally. Now, AB, before we go, I do have one bonus mistake that I want to add in, and this really is timely. So, forgetting the history of the stock market, let's take a look at the last couple of years. Market's been really, really hot. Now, that's not to say it will do that, not do that, continue or not. But I think having unrealistic expectations for 2025 is a mistake that we will see with a lot of people as we head into the year.
Look, that's very true. You're already starting to see that with the superannuation industry. I did pick it up on my radar because it's something I follow very closely. Over the new year, we're saying, look, time to manage your expectations. Don't expect the halcyon times that we've seen over the last 2 years, which it sounds like you're putting the white flag up before you announce your 12-month results anyway, which I suspect might be a little underwhelming for people nonetheless. But look, if you take a look at and we've covered this previously, we've got a new president. Typically out of the S&P, I think 12% is the average gain for the first year of a new presidency on average.
Yeah, roughly about 11%. 11%.
Yeah,
that's right.
For that first year of the term of a new president. So you've got that historical tailwind before you start. Yeah, you've got an incoming president that's looking to cut corporate tax and invest very, very heavily in the US. Against that backdrop, you've got to ask yourself, is that good or bad for equities, typically? And you'd think that it would be quite positive. So I think it is important to manage expectations. 40, 50% years, we've had out of the US, for example, 2 of the strongest years in the last 2 decades, over the last 2 years.
Crazy.
That said, we've also had a gold rush in the tech space particularly, and more recently in the AI space that's been driving that. Do we expect to see that continue? Or do we expect to see it falter? And we've talked quite extensively that, we still like the idea of tech, but being fairly selective on what and when within that sector. So I think you've got to be careful that you don't fall into a trap. I think it is very, very important to manage your expectations that 40, 50% returns out of a market are highly unusual and shouldn't be treated as the norm. I also believe on the other side, it's like, you've got 2 voices going, one either side, optimistic and pessimistic case, that you also have to be objective as to what you're looking at. And if you go into this, it's like if you say, I'm feeling a bit tired, I bet I'm going to get a cold. Guess what? You get a cold. Whereas if you say, I'm fine, I'll have an early night, I'll be right tomorrow, invariably you're right. So you can talk yourself into things too. So if you talk yourself into a more, I'm not going to say pessimistic outlook, but less optimistic, you'll choose to pull shots that you should be taking purely and simply because you'll have that nagging noise at the back of your head saying, oh, the last 2 years have been pretty strong. This one probably won't be. Don't be too gung-ho. And I don't mean to be gung-ho, but you have to take action if you want to be successful. And this is where objectivity comes in. See it for what it is, not for what you want it to be. And the way to see it for what it is to learn how to analyze objectively, which we spend an awful lot of time teaching.
Absolutely. AB, I think this has been really comprehensive for our listeners today. There's been a lot of nuggets of gold in here, so thank you very much for your insight.
My pleasure, and I'll work on my outfit for next time we speak, but hopefully the pearls of wisdom come through.
Reprimanded for next week, I think. We'll need you in a suit and tie.
Do I need to shave my legs, I wonder?
Yeah, I can give you a few tips on that, borrow some of mine.
More information than I already needed to know.
Cheers, AB.
Catch you. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.